Hello friends, this is Raj Sastry from Raj Option Trading. Today is November 19, 2021. We will talk about one of my favorite option strategies. It's the selling put options. Selling put options is an income strategy with a high probability of success. That's why so many people are attracted to sell put options, and it's very simple. So with that, let's jump in and get started. As you see here, seller of a put option will make money if the underlying stock increases in price, stays the same, or, or decreases slightly. There are a lot of combinations where you can make money. That's why people are attracted to selling put options. And seller of a put option has an obligation to buy the stock at the specified price. So that's why you are taking a risk here. For taking that risk, you are rewarded with the option premium. You get to keep it if the stock stays above that price, and you can also sell the put option or buy back the put option and make some money that way too. So with that, let's jump in and get started. As you see here, for a put option seller, you got to have a bullish outlook. You want the stock to go higher, and the risk is unlimited to a maximum equating to strike price less premium received. As an example, if you sell a put option on a stock which is around $30, think about PAGS as an example. Your risk is really, say you collected $1 premium here, your risk is 29 times 100, it's 2900. It's not unlimited theoretically, it's really stock price minus the premium, or the strike price minus the premium that you received. Maximum reward is limited to premium received here. That's why some people are not attracted to put option selling, because the maximum money that you make is capped. It's the premium that you received. Even if the stock goes up 100 points, you still get to make your limited profit here. Your profitability is capped. That's why some folks are attracted to call buying here, where you got unlimited profit potential. So this is where you got to think through. One, put option selling, more probability of success and less money because profit is capped. Whereas buying call option, you got unlimited profit potential, but probability is really a little bit lower compared to selling put options. And this can be combined with other positions. As an example, you got a high flying stock like Amazon.com. You may not want to just buy sell a naked put here. You can sell a put vertical here, so that way you can make some money and your risk is limited because you're doing a put spread versus a naked put here. So with that, let's look at some of the things you have to watch out for. So when you sell a put option, you want to sell when the volatility is very high or relatively high. I've seen so many people, they get up in the morning and sell some put option. They think it's a free money, it's like a ATM machine, but that's not the case. You got to restrain yourself and sell the put option only when ATVI percentile is high. So that will give you a very high probability of profit versus day in and day out selling put options. And identify clear area of support. You can look at the chart and see a clear area of support. You can look at a 1-year chart or even 2-year chart, for example. Understand a clear area of support. You sell the put options underneath that support level here. That way you're a little more safer. And you can also sell put options at most, say 45 to 60 day to expiration. Don't go beyond that. And also, unless you're confident about the stock, make sure there is no earnings or major announcement in between that can take the stock up or down drastically. You got to be a little bit careful on this, but if you have a favorite stock like Apple or Amazon, you don't need to worry too much, but generally be careful. Watch out for earnings in your expiration window. And one of the reasons many people love selling put option, because passage of time, or a theta decay as we call it, that's your friend. as long as stock stays above the strike price. That's why so many people are attracted to selling put options here, because they sell a put option when the volatility is high. For example, Dow Jones Industrial Average fell down by 200 points, Nasdaq fell down by 500 points. I'm just giving some example. Those are the good time to sell some put options and just keep waiting. It's a waiting game here. As time passes by, you make money here. That's why so many people want this passive type investment. They get up in the morning, if the IA percentile is high, sell some put option. Otherwise, take it easy. The put option that they already sold will make them money. So that's why there is so much attraction to sell put options, because of this theta decay. And make sure the delta is around 15, or probability of touch is around 30. As we go through the few examples, I will highlight this so that way you understand this very well. And avoid stocks with very heavy debt. You don't know, you want stock to be a little bit sound. you know Selling put option, think about as if you're buying the stock. When you're buying a stock, you want a bullish outlook, you want to make sure stock will go higher. Same type of methodology will apply when you're selling put option, similar to buying stock itself. All the stocks that we will look at, you can either sell the put options or you can buy stock outright, because we will make sure fundamentals are good, whether you want to sell put option or you want to buy the stock outright. So with that, let's jump in here and look at some do's and don'ts of selling put options here. So from a do perspective, a best time to sell put option is after negative news. Think about huge earning miss, Apple rolls over. That's why you can sell them put option. That's similar to selling insurance when house is on fire. When a house is on fire, people want to pay good money for insurance. So at the same time, you get to keep some money. And as long as you do your homework and be careful, that's the good time. House is already on fire, and you get a good premium by selling put option. And you can insure for a lower price, as an example, because house is already on fire. So that's why selling put option is similar to selling insurance. Folks often give example of Warren Buffett. Warren Buffett made so much money selling insurance. This is something similar. You're looking at your favorite stock here, and you want to buy at certain price, and you sell put option and receive some premium. If the stock comes to your price, you can buy the stock. That's why it's one of the best strategy. It's a little bit capital intensive, but it's a good strategy. And oftentimes you already have a good portfolio, and your broker will give you money to sell put options. You can basically draw off of your existing margin itself. And look for some great stocks, either growth stock or a value stock. A growth stock, great stock with a temporary weakness, that's when you sell put option. And put options on your favorite ETFs, you can do that too. When market drops big time, look at QQQ, SPY, IYR, IBB, XLV, SMH, even all these great ETFs that we have, which are very liquid. You can sell put options on those and make some good money. These are a little more stabler play here. I know a lot of people, just get up in the morning, if the Dow Jones drops down by 200 points, sell some put option on DIA. If Nasdaq falls over, sell some put option on QQQ. That's one of the favorite strategy, and you could go all the way very very deep in the money and sell out there. So that way you're a little more you have little more margin of safety here. That's what a lot of people do. And don't be afraid of option assignment. It's already one of your favorite stock. You want to buy maybe $10 below the current price. Don't be afraid of option assignment. Many times in my scenario, a lot of gains I made is really around after the assignment. Assignment tells you, hey, what, it's a turning point. Stock came below the support level. That's a great buying opportunity. Some folks will try to shy away from it. Don't shy away. If you want to roll the option to next month, you can do it. But generally, if you have money, if you like the stock, take the assignment. No big deal here, and you can make some good money. You can sell it after a month or two. It will nicely come back many times. and lighten up when the market is up. Sometimes I give the example here. When the stock market is up, you feel light because you sold a lot of put options. The weight of the put options will decrease. That's when you make money. Lighten up at the time. But when the stock market rolls over, you feel heavy because you sold a lot of put options. Put options will really consume more and more margin. That's why you feel heavy. That's why when the stock market is up, even if you make some 50% profit or 25% profit, take some profit off the table. Feel lighten up. And when the market tanks big time, you have money and margin to buy, or to sell more put options. And from a don't perspective, bad time to sell put option is after accounting scandal, or a management is at this time management may be cooking the books. Don't sell put option. That's not a good idea. From a timing perspective, company has got a bad rap here. We don't want to be siding with such companies. And also, there are some stocks with a consistent deteriorating performance. If you look at a 2-year chart, clearly you will see a downward trajectory. Don't go after such candidates. We want either a stable, stock chart with the higher highs and higher lows, or at least some good trajectory. But if the stock is spiraling downwards, don't buy put option. Not worth your effort. And avoid the stocks with a low open interest and high bid-ask spreads, and also low volume. So that way you get some liquid stocks when you sell put options. So it's easy to get in and out quickly. And don't take too much margin. It's often what people do is really, once they sell put option, make some good money on a monthly basis, they feel like, what, I made $10,000 last month, let me make $20,000 next month. They get caught up in that game, and they ignore the timing and keep selling put option every morning. That's when you get burned out, and the market tanks. You get margin call. Not worth your time. Don't do that. And buy back the options when you reach around 50% of profit, or sometimes even 40% of profit. That way you take some risk off the table, and you have money to play when the market tanks. These are some quick do's and don'ts, when you want to sell put options to generate consistent monthly income. And with that, here are some good names with a high IV percentile and low volatility. Look here, we got Global Payment Network, GPN, we got PAGS, Brazilian play, Encino, Bank Operating System, a great stock here. Visa, all the fintechs are rolling over right now. You could buy some, sell some put option on Visa here, or a put spread. Got Alibaba. Alibaba came down, high IV percentile. You could do put option on this one too, sell some put option. We got Insight and Anaplan, same story. All these stocks have one thing in common. These are all great companies, and they got low RSI, meaning stocks are sold off right now, and they got high IV percentile, means you can get some good premium if you sell put options. So that's a common theme in these stocks. That's many people like these stocks because they are a little more stabler type stocks here. So with that, you might wonder, when do I sell put option? What is put option? Can you explain? So this attempts to explain that a little bit. As you look here, we got a stock here, your favorite stock. Think about maybe PAGS here, Brazilian play as an example. Stock is around $30 here, and you feel good about the company. You know what, Brazil right now, inflation is too high. I'm sure this company will come out of this inflation and do well in the future. You might say, I feel comfortable right now to sell some put option, say around say $30. Say stock is at $40 as an example. That's your current price, and you feel comfortable the stock will not come below $30. You will sell some put option at a strike price of $30, which is $10 below current stock price. You feel comfortable. You feel that stock will not go below $30. You sell a put option here for maybe 40 days or 50 days out expiration, and collect $2, which is $200. So that's what you do. Very simple, just one leg. You're not selling too many legs here, and you collect $200. And now with the waiting game, you kind of sit here, wait. As you wait, if the stock goes above 30, stays above 30, you'll start seeing some good profit, profit and loss, points to profit. Every day passes, there is a theta decay, you generate some money. So as long as the stock stays above your strike price, $30, you're golden. That's your profit zone here, all the way from $28, which is break even, and all the way higher. But your money that you make is limited or capped at $200 here. That's why it's one of the great strategy, whether the stock comes down slightly up to your break-even point or goes higher, you don't care, or it stays the same, you don't care. As long as it's above your strike price, you'll make nice money here. That's the attraction of selling put options. That's why so many people do it day in and day out. And your last zone is really the money you collected, which is $2, minus your strike price, which is $30. That's $28. That's your break even point. If the stock goes below that, then you'll start incurring loss here, and your margin, available margin, will come down. So that's why you got to be a little careful to sell too much, too much options, and also too much time to expiration. So limit your option expiration time to maybe 30 to 40 days or 50 days or even 60 days at time. So as the stock falls below $30, that's when if you sold so many put options, your broker will call you, say, hey, what's up, your margin is getting low here, put up some money. That's why be careful, don't use all your margin when you sell put options. Be consistent, maybe use 30% of your margin or something along those lines. Keep the money available. When the market rolls over, you can sell some. That's why selling put options always go by setup here with the low RSI, high IV percentile, and generally stocks trending higher, with the temporary weakness. That's when you sell. Don't overdo it. If you overdo it, you get a broker call and you'll be panic. So with that, let's jump in here and look at top stocks to sell put options. Generally what I do, I want the volume to be more than 1 million shares. I want liquid stocks. Otherwise, it's not worth my time. I don't want to jump into scenarios and sell some put options for very illiquid stocks. And I want the implied volatility or IV percentile to be high, at least above 45 or so. And I want because I want high IV percentile, because I want to receive more premium. If the premium is less, it's not worth worth the risk here. That's why I want high IV percentile. And I want low RSI. I want low RSI because I want stocks to be down at this time on a temporary weakness, and stock has more room to run. So that's why I want low RSI, because the moment the RSI is low, it tells you stock has already sold off here, and there can be a good bounce if you chose your stock carefully with some good fundamentals. And I want a positive gross margin. This is where your fundamentals will come into play. I want a positive gross margin, so that way company is not a money loser, or they got a nice efficiency when it comes to margin. And I also sorted by highest volume on top, so that way you get highest liquid stocks on the top here, so you can play along. So with that, now we got examples here. Look here, we got Alibaba on top here. Alibaba came down by 11% yesterday. Analogies sell insurance when the house is on fire. Right now, Alibaba seems to be on fire with the down 11% yesterday. I love Alibaba because nice gross margin. Look, 40% gross margin, 19% net margin. Company is making money, and there is a quarter-over-quarter sales growth here. Debt to equity ratio is low. That tells you there is a low debt here. Stock is sold off with a lower RSI. Look, IV percentile is 52. That tells you right now IV is high. You will get a good premium. So that's how I look at companies when I sell put options. We got a few more examples. Peloton, a lot of negative news in the press right now. Stock came down here. Look, high IV percentile, low RSI. Nice growth rate here. Company is not making money. So if some of you are a little conservative, you could skip Peloton if you want, given the net margin is negative and debt to equity ratio is a little high. But if you're a little bit, out there and you are a little more risk averse, you could sell some put options on Peloton, make some money. Generally, stocks like Peloton, when bad news is a little bit stabilizing, stock will generally go higher. But understand, to sell put options on Peloton, you got to be a contrarian and you should be able to take the risk because there is a little more debt on the balance sheet and companies are not making money yet. So I will leave it up to you. If you want to play a little safe, you can ignore Peloton and go with stocks like Alibaba with the positive net margin. And then you got few more companies. There is a lot of news about Alibaba in the market. Sorry, Activision Blizzard. They got some scandals going on. CEO knew about it, and so on and so forth. That's why stock is tanking. It came down here. Look, nice IV percentile, low RSI, nice net margin. Companies making money. So these are few examples here. I want you to take a look at this and look at things like debt to equity ratio. Are you comfortable when the stock has got debt on the balance sheet? Are you comfortable to sell put options when net margin is negative? If you're not, skip those. There are so many options here. You don't need to sell put options only on such stocks if you're not comfortable. We'll look at that list also as we go forward. So this is page 1 here. Then we got page 2. If you look at page 2, we got a few more stocks here. You got Stitch Fix, down of late. Keep watching the short ratio, high short ratio here. And we got JAMF. It got clobbered 2 days ago. Even down 27%. Right now it's stabilizing. You could sell put options on such stocks after a big drop, huge price drop. Stabilizing now, that's a good time. If the IV percentile is still high, you could sell some put options, make some money that way. And then you got a few more. I love fintech, shift 4 here, fintech play. It's also trying to go higher here. In the 10-day, it's up here. Right now, high IV percentile, low RSI, little high debt ratio, comes to the territory. It's a fintech play, which may be okay. So these are few examples here. Even Encino bank operating system, you could sell some put options here also. So that's your page 2 here. And then we got, many of you, hey, you know what, I don't like to look at low debt candidates. So we ignore the low debt candidates. These companies are a little more safer. They don't have too much debt on the balance sheet. So this is a little more for you, safer folks. So this is a short list here. Keep watching debt to equity ratio. It's all below maybe 0.8 here. A little more conservative. And if you want to be more conservative, go after just the net margin positive companies. So that way you look at stronger companies, the companies that are making money day in and day out, and still with the high IV percentile. You could look at these names here and go from there. So with that, what we'll do now is we'll go to Thinkorswim platform for 3D from 3D Ameritrade and look at few examples, and I can walk you and tell you how can you sell some put options and make some money. With that, let's jump in here and go to Thinkorswim platform. As you can see here, we got futures market here. Futures are indicating a 12-point drop in the S&P 500 futures. Nasdaq futures up nicely, up 77. Wow, that's a good one here. They're doing nicely here. Dow Jones Industrial Average is a little bit, 238 down here. Looks like they're having a little bit tough time here. Industrials are not doing great, as you can see here. Russell 2000 is also dropping a little bit, as you can see here. Russell is a great play here. You could, buy some great Russell stocks and go from there. So with that, for today, we will look at selling put options and focus on that scenario here. So with that, what we'll do is we'll bring up a 1.5 a chart here. This is one of my favorite chart. I look at a few indicators and that will help me out. Let's look at Alibaba first. We looked at Alibaba. Alibaba, stock fell off. Still, IV percentile is high. As you look through Alibaba, keep watching here. Stock is not doing great, as you can see here. It's kind of slowly, coming down, as you can see here. So what you can also do, in case of stocks like Alibaba, just to get a nice, support level, you could go after a 2-year chart here. So I will say I want a 2-year, so 2-year 1 day here. So as you look through here, from a support level perspective, look here, you got 173, around 173 or so. It's a good support level. Stock is around, right now it's at 143. Let's see here. Yeah, 170 was a good support level, and next support level is around 140, which is current stock price. So you could even go maybe $10 below this price here, 143, and sell some put option. Let's go back to 1 year chart so we can see things a little clearly here and go from there. So as we look through here, we got Alibaba. Alibaba is a great Chinese play, e-commerce play, as many of you know. Stock is trying to stabilize in the near term, as you can see here. Earnings is out. Stock came down drastically. 11.18 yesterday was the earnings. RSI is low. Looks like stock got oversold here. That's why RSI came down. I love when RSI is down and trying to trend up. That tells you momentum is coming back to the stock here. Look, from a IV percentile perspective, this is one thing I always look at when I sell put options. I want the IV percentile to be trending higher. That tells you right now IV is high here. Many times I look for IV to be the current IV percentile to be higher than the historic IV percentile. Right now, as you can see here, the pink line here is historic IV percentile. The blue line here is the current IV or implied volatility. If the implied volatility is trending higher, that's when you sell some put option. Keep watching here. IV percentile is 52. That's why it's a good one to sell some put option. And then I look at DMI chart. DMI chart is one of my favorite. Typically tells you when the blue line is on top, that's a bullish scenario. When the red line is on the bottom, that tells you it's a bearish scenario. Right now, clearly, red line shot up, blue line came down. That tells you it's a massively bearish right now. That's why you get a lot of premium, because it's a massively bearish. That's why you get a lot of premium here. And as you look through here, we got volume average on the balance volume. It's ticking a little bit lower, very consistent. When stock rolls over like this, on the balance volume generally comes down. And look at the check in money flow here. It also came down. Now it's trying to point, trying to see where to go. Generally, when stock rolls over like this, on the balance volume comes down temporarily, then it will go higher. Keep watching here. Stock rolled over on the balance. Check in money flow came down, then it went higher. So that's why this is a perfect time to sell put option. Generally, I'm a little bit bullish about Alibaba long term. Right now, there's a temporary weakness after the earnings. That's when you have to look and see if you can sell some put option here. So with that out of the way, let's look at the option chain here. We got Alibaba, as you can see here. Alibaba all-time high is 280. Right now, stock is at 143. You get a nice 50% haircut in Alibaba in 1 year time. So generally, you could, if you are bullish on Alibaba, you could go 63 days out, or I think it's better to stay at 42 days out. Earnings is just now out here. So with that, one thing I always look for is, look at option statistics here. Look, we got a lot of people buying call options, 984,000 call option contracts traded. Put option contracts traded is 623. That tells you a lot of people are bullish about Alibaba in the longer term. That's why they're buying call option. That makes the put call ratio 0.6. Anytime put call ratio is less than 1, it's really generally seen as a bullish trend. But if the put call ratio goes above 1, that tells you more people are buying put option, betting the stock will go lower. And if you look at the VWAP here, VWAP is 144, stock price is 143. That tells you stock has a tendency to go higher to the VWAP here, generally bullish here. And implied volatility is 53.93. That's a good one. So as you look through here, let's generally look at 42 days out option here. As you look, keep watching the, keep watching here how much money you can make here. So look, you have to look at the probability of touch here. Keep watching probability of touch. We got 74, 31. Around 31 is a good one here. Probability of touch is 31%. If you sell 160, but 160 is already above the current stock price. What we'll do is we want to go lower here. keep watching. We got 36 probability of touch here, 120. Stock price is 143. We are looking at 120 here. If you sell a 120 put option here, you can make around $1.89. That's a good proposition. You could if you can sell a put option here, expiring in 20 in 42 days here, December 31st, New Year Eve. You'll make some nice money, 189 $1.89. And if you confirm and send here, so by selling this put option, you are making $118, and your expiration is 42 days out. And your borrowing power effect, if you have some margin account, a broker will let you borrow $1,219, and you don't need to pay any money for this because it's from your existing borrowing power. It gets decreased. So in this scenario, as long as Alibaba stays above $118, you get to keep this premium that you received. If Alibaba goes below 118, or even your strike price, which is 120, if if you like the stock, you can just get it assigned to you, and you can buy the stock. But if you don't like to do that because you don't have money, as an example, you can roll over, and you can say, what, instead of expiration in 31st of January, I want to roll this to next month. You can do that very easily. Or if you can buy back this option on a little bit loss year, you can also do that. So with that, generally, I'm bullish about stocks like Alibaba, especially when they have some temporary weakness after the earnings. That's when I kind of sell put options and go from there. And some people might wonder, hey, naked put, I'm not comfortable, not my cup of tea. You don't need to do that. You can just do a spread here and go from there. So if you want to do spread, typically I recommend here you got 125, 130, 120. You could sell a $5 spread. If you're up to it, you can say, what, I want to take risk only $5 or $500. You could just go here and sell a vertical here. That way your risk is capped. So you're selling a 125 strike price put here. You're buying back a 120 strike price put here. Your risk is just $500. You'll sleep very well at night here. And for that, you're making $86 here. That's your credit. So here, this is a little bit conservative play for you who don't want to take too much risk, which is understandable. I do this a lot of times with this little bit high price stock. It's a little more safer. Your buying power effect will be 414 here. It will not change drastically, and your max profit is $86. You can do something like this, day in and day out when the IV percentile is high. This is a little more safer play here, and you can sleep at night. Your margin will not fluctuate dramatically. Similar to when you sell naked put. This is a little more defined risk strategy, as you call it. So with that, you could confirm and send and go from there. And next, let's look at one or two more here and go from there. So let's look at Peloton here. Peloton is for you who are a little bit wild traders. Right now stock rolled over. Let's look at the chart to begin with, and then jump into option chain here. Peloton, as you can see here, this was doing great last year. Everybody stayed at home, bought a Peloton machine, started working out, and watched their favorite friends and some community type environment. Right now, Peloton is has dropped after the earnings. Now it's stabilizing, and IV percentile is still high, as you can see here, 62. And right now it's sold off. That's why RSI came below the oversold level here, trying to bounce a little bit, as you can see here. IV percentile shot up, as you can see here. IV is generally trending higher. This is when I sell put options. Look, DMI chart is overly bearish. Red line went up, blue line came down. Now it's a little bit stabilizing, but still it's overly bearish here. Look, volume average dropped, which is very typical when the stock tanks like this. And smart money, look here, this is the divergence here. Even though there is a bearishness here, smart money is flowing into the stock. There's these big fund managers. They see the opportunity here, they are buying it. That's why this is a play where you got to understand the stock a little bit, understand its potential, and look what these big money managers are doing. Their smart money is flowing in. You could take calculated risk here, and also keep watching the levels here. If I go, Peloton is a relatively new stock here, so let's go 2 years out. I don't think it's traded for 2 years. Look, if you see here, right now it's stabilizing around 44, and you could go even back to say 2020 May here. It's around $31. You could go a couple dollars below the current price here and sell some put options. We'll go back to 1 year as usual so we can see it a little better. So with that, now let's go into option chain here and sell some put option. So as you see here, Peloton, $48 stock, went as high as $171 in a 1 year time frame. Wow, that's a huge 52-week high. It's at a really, really deep sale right now. And as you look through here, keep watching the put options here. Then keep watching probability of touch here. Probability of touch around say 22%. You don't make much money here, and then you got probability of touch around 40 here. You make $1. So right now stock price is at 48. You could sell some put options at here at 40. If you like to buy Peloton at 40 here, this is a great one to do. You could just buy it here and you collect $1.06 here, confirm and send. Your break-even point is 38.94, which is around $10 below the current stock price, and your max loss is 3,800, and your buying power effect is 414. So this is one way to play here. You got to be a little bit risk taking type personality here. If the Peloton rolls over, your margin or buying power will keep increasing, so you might get a margin call. But if you don't want to do that, you could do a different strategy. You could do a spread strategy. You might say, what, heck with it, I will only take $10 risk. So you could say, you could sell a put spread here. You could say 40-30 spread here, $10 wide spread. You could sell that one here. Go to here, sell vertical, and say I want to sell $40 put here and buy back $30 put. You're taking a $10 type risk here, and for that you'll collect nice 93 cents profit here. So here, if you do that, your max loss is capped here at 907 here. If the stock goes down, you don't need to worry too much. And your buying power effect also comes down a little bit. It's 427 here. This one is for you who want to sleep at night, don't want to worry too much about this margin account fluctuation. This is a better play here. You could go and do this one, and typically it serves you well. And you don't want to be selling naked put. Defined risk strategy, as you can see here. We'll probably look at one more here and take it from there. And next one is Activision Blizzard, ATVI. There is a lot of bad news in the press about Activision Blizzard, how the CEO knew about the scandal going on all along. I don't like those stories, but generally I want to tell you how I look at the stocks here. As you look through here, we got Activision Blizzard, a video gaming stock, as many of you know. Stock rolled over last couple days. Right now, RSI is trying to stabilize, still going down, trying to stabilize. IV here, implied volatility is going higher. That's when you sell put options. And right now, it's bearish from a DMI perspective. Red line shot higher, blue line came down. And as you can see here, smart money is wondering where to go. It's stabilizing right now. On the balance volume indicates drastic drop here, meaning there are more sellers than buyers. So this is a perfect storm here, so you could take advantage. Generally Activision Blizzard is kind of trading in the sideways for most part. Now with this big drop here, it could be opportunity. Keep watching here. Big drop, stock stayed around the same price here, went higher. Big drop, stock kind of stabilized, went higher a little bit. So this is a big drop here, so you could generally assume it will be in the trading range or maybe come down a little bit. That's why you could make some strategy like this and sell some put option. So if you want to look at a little bit bigger picture here, a 2-year chart, look here, we got nice support level, you could say around say We got here price around says 50 or 50 55. There's a good support level. You could look at that one too. So let's do one thing. Let's go to option chain here and see what we can do. As you look here, you can go 42 days out in Activision Blizzard and keep watching probability of touch here. You can go around say 38%. It could be okay, maybe a little more risky. You could try this one. And sometimes what I do is really, because 42 days out you may not get too much money, you could even go 63 days out. This is also okay here. If you go 63 days out, your stock price is at 62. Look, keep watching the probability of touch here. Probability of touch around 25%, you get some good 55 cents here. And if you go higher here, you get 76 cents. This could be a good one here. Probability of touch around 33. You could sell this put option here and make $76. Confirm and send. If the stock goes below 51, you'll end up losing money. If it stays above if it stays above your strike price, you'll make money. So you're basically assuming or betting the stock will not go below 52.5 here. For that, you'll get to keep your money. If you're a little more risk averse, go with the say a spread here. You could say I want 55 and say 45 spread, a $10 wide spread. You could take a bet here and do that. You could sell a spread here. So 55, you're selling it and you're buying 45. It's a $10 wide spread here. And for that, you collect 82 cents here. And as you can see here, right now your buying port effect is just 589. As long as stock stays above 54.18, you'll break even. So this is another strategy for you who want to sleep peacefully at night. So, this is one. I think we will look at one more and wrap it up and go from there. What I will do is I will look at GPN Global Payments, one of my favorite stocks here, and see what we can make out. So GPN, if I look at the chart here, nice looking chart as you can see here, going down of late. Great company though. And as you see here, right now negative DMI perspective, implied vol is going higher, high IV percentile 68 or so. And right now smart money is trying to flow into the stock. That's a good sign. And if you look at a 2-year chart to identify support level here, keep watching here. So we have good support level somewhere here around 114 or so, which is $10 below the current stock price here. You could kind of think of this as a support level here. With that, let's go in here and look at GPN. Global Payment Network stock price is 126, all-time high is 220. It's almost at a 50% sale here. Look, we got a probability of touch here at 32. You got nice $125 premium here. You could sell some put option here if you're up to it. Naked put. $125 is your max profit. If the stock goes below 103, you'll start incurring loss. And this is one way to play here. But if you want to be conservative, you could do a put spread here. You could say 110 and 100 spread. So let's look at that one. That could be better for many of you who want to sleep peacefully at night. So you could sell this spread here. There you go. So we are selling 120 and we're collecting nice money, and you are buying back. We are selling 120, buying 100. There you go. So you're collecting 85 cents here. Confirm and send. If the stock stays above 109, you'll break even. And you get, if the stock stays above your strike price, which is above $110, you got to keep entire money here, $85, and go from there. So as you can see here, you don't make lot of money, but you can keep selling this put option every say 40 days or 60 days out. Keep generating a consistent income as the time passes by. If the stock stays above your strike price, you generally make nice money here. It's one of those passive income type strategies. Don't overdo it. Don't sell put options on a lot of stocks. That will have you trouble when the stock market rolls over. You'll get a margin call. So with that, I think it's a generally good strategy if you stick to it. The principles, keep watching the RSI levels, low RSI, high IV. Some of your favorite generally fundamentally good stocks you could sell put options and earn consistent monthly income. So with that, thank you very much. Happy investing and trading. Please subscribe.